I'm sorry, the Fed did what? What's up, guys? Welcome to this episode of the GrowingAU Show. It is no question recently that the market has been on a roller coaster ride of gains and losses. It seems like every day the market being up, a whole bunch of points or down even more points is commonplace. And really, at this point, no one's really even shaking their head at it. Now, I don't know about you, but if you're anything like me, I would give almost anything for just a day, maybe 2 days at most. I don't want to ask too much of just some sideways trading. I love gains as much as the next person. I want that thing to keep skyrocketing onward. But maybe just a day of calmness, some day of just normalcy would be appreciated in my book. But despite that, that is not what is happening. Market's been up and down recently. We saw last week some of the greatest gains in the Dow Jones in recent history, but then right after that, the market falling quite drastically. At this point, it is very clear that we are not in some sort of just dramatic V-shaped recovery. At this point, looking more like a W, or what's a W plus a V plus a W? But you get my point. It's up and down, and it looks like it's going to keep doing that for at least the foreseeable future. Something has happened, though, last week that has led this to happening. I want to talk about some of the news that was released by the central bank of the Fed, talk about what they are doing as far as interest rates are concerned, the effect on the market, and then finally at the end of the episode, we're going to talk about my personal opinion of what you need to be doing as an investor. All right, let's jump into this. This is coming from an article from the Wall Street Journal, and what has happened is the Fed has signaled plans to keep interest rates near zero for at least the next few years. This is backed by Jerome Powell's statement that we are strongly committed to using our tools to do whatever we can and for as long as it takes to provide some relief and stability. The S&P 500 initially rallied when the Fed released its policy statement after the meeting, but unfortunately dropped to being down 17 points or a negative 0.53% later that day. 10-year Treasury yield fell also 0.1 percentage points as well. What has happened is that the Federal Reserve has lowered interest rates to zero. And really what was happening in this meeting was they were talking about whether or not that is going to continue for the foreseeable future. And some of the statistics that we're looking at here is that 17 of the officials who participated in the rate setting meeting said that they would hold rates near zero next year. 15 of those officials also projected the rates that would stay near that point through 2022. Mr. Powell goes on to say that we are not thinking about raising rates. In fact, we're not even thinking about raising rates. Again, we're not even thinking about raising rates. In addition to that, these officials also said that the unemployment rate would be about 9 to 10% at the end of this year, which would actually be considerably far down from the 13.3% that we are at now, or were at in May, but would still be above the 3.5% that we were in February before everything that happened. Fed officials also claim that the economy would contract anywhere between 4 and 10% this year, and then the projections for next year were kind of drastically uncertain. Some suggesting that the economy would contract an additional 1%, while another percentage of people are saying that the economy would grow about 5% coming into 2021. Now, one thing that happened is we saw that big market rally last week because of the fact that the 19% unemployment rate that was expected was drastically undercut by the 13.3% that was actually reported, and that caused the market to do rather well. Now, Mr. Powell actually came out and talked about how he kind of downplayed this a little bit. He said that it was a welcome surprise, and we hope that we get many more like it, but I think that we have to be honest, it's a long road ahead of us. He's talking about because nearly 20 million fewer Americans are employed right now than what were employed in February. And Mr. Powell goes on to say that it could be some years ahead before we go back to those people finding jobs. He additionally states that we're doing a fair job getting through the first few months, more than a fair job. The question, though, is that the group of people who just won't be able to get back to work quickly, what about them? And I think that really kind of is the question of the hour. We are seeing a lot of kind of resurgence in the economy as things begin to open back up. Unfortunately, though, as we've seen in some of our southern states, as they have continued to ease restrictions and open the states back up, we've also seen a resurgence in another unmentionable that we won't say here, but we've seen a resurgence in that as well. And the question is, how long is that going to continue to plague our economy, plague our country, and unfortunately just keep business and kind of economic growth at a standstill, or at least a significantly smaller rate than what was seen earlier this year. All in all, the Fed's actions have buoyed financial markets for now, with stock markets recently returning to positive territory for the year, but economic cross-currents have made it hard to diagnose the underlying damages inflicted by the virus. The market has been crazy recently. I mean, you can look at any numbers and see how drastically they're changing from day to day, week to week, to know that something is going crazy. And it can really lead to the question, what do we do? You, me, regular people, just normal investors, how do we make sure that our money stays safe? How do we ensure our future growth? What's the proper course of action here? Well, I think there's really two courses of action to take. And I'm going to talk about the person who has not yet started investing and then somebody who already has their money in the market. For those of you that have not yet started investing, which was mostly myself up before the crash, that's when I really started to get into it hardcore as far as my actual money in the market is concerned. And I increased my positions rather drastically, putting a couple $1,000s into the market right after the crash. The reason that I would suggest this is that right now, with things being so dramatically off of their 52-week highs, there's a good chance that we're going to be able to get into a lot of assets at a bargain. This is called buying on the dip. There are a number of investors out there that would recommend against this strategy. We can afford to allocate some of our resources to slightly more riskier assets and stocks in this case in mind, just because we have so much time to leave our money in the market. Of course, talking about long-term investing here, not always a big fan of trading, but I think right now there's a lot of stocks that we can get into that are dramatically undervalued due to largely in part the effects of the virus. And I think that allows a wonderful buying position for a lot of these stocks for new investors. And like I said, with time on our side, we have plenty of time to ride the economic growth wave into the future. I think what it comes down to, for those of you investors that have money in the market but still have time on your side, I actually want to reference you over to a book called The Little Book of Common Sense Investing by John C. Bogle. Just finished it actually recently. And the one thing that he talks a lot about in that book that I like, the quote that he uses is, a lot of us have maybe heard the term before, don't just stand there, do something. Well, he says that when it comes to investing, perhaps one of the best things we can do is the exact opposite. Just stand there. Don't do anything. Because as we've seen, every economic downturn in the future has historically been followed by an economic upturn. Everything follows reversion to the mean, the law of large numbers. Everything is governed by it. At some point, things are going to continue to go back up, back down, but everything eventually resorts right to that equilibrium point or that medium, which means that even though we're in a negative point right now, it eventually will rise back up. And so I think for a lot of you right now, if your money is still in the market, I wouldn't be super worried and concerned about liquidating that asset right now. I would just be worried about holding on to it, knowing that there will be brighter days ahead, especially if you have faith in your asset allocation policy and your plan in the past. You have a decent strategy that you have, developed before this all took place. I don't think there's any reason you can't stick to that strategy. Keep putting in that consistent percentage into your account. I think it will allow you to see some really great returns into the future. Just staying the course through this, understanding that right now is an incredibly volatile time. So the worst thing we can do in a volatile time is start to take super drastic action, because that's just going to be compounding your volatility. Whether you believe in what John C. Bogle is talking about and don't do anything, just stand there, whether you're believing in putting in some more money, buying on the dip, increasing your positioning in certain assets, whether or not you like what the Fed is doing by keeping interest rates near zero, despite that, right now the market is still going crazy. I do wish everybody the best. As I always say, do seek professional financial advice before making any financial decisions. But right now, it's a crazy time. I do believe it offers some wonderful opportunity for new investors, us young investors. We have time on our side right now, and it's our best chance and in our best interest to use that time. So the best thing we can do is get started, whether it's in a Roth IRA, whether or not it's in a personal brokerage, maybe it's even just starting a 401k through your work. Get started investing. If you want to know more about that and how to use your money efficiently, check out this video here, and we'll talk more about that there. Appreciate everyone watching today, and we will catch you next time.